When you go out looking for fixed return investment options in the market, the most popular is of course fixed deposits, which don't give very high returns. So you expand your horizon and look for other options. You've got debt mutual funds, you've got corporate bonds, you've got government bonds, you've got secured bonds, unsecured bonds, debentures and whatnot. So these are a lot of debt securities or debt backed securities, which means when you pay money to invest in them, you're actually giving a loan to someone who has promised in return to give you a fixed rate of return. This return could be something as low as 6-7% or could also go up to 15-16% when these are unsecured bonds. With unsecured, it means there is no asset, they've just taken money, there's no collateral, and God forbid if it fails in the future, there's a possibility you will get absolutely nothing in return. So you, being a prudent investor, think that I want to put my money in secured bonds, which means that the issuer who is issuing the bonds and I'm purchasing them by giving the money has a bunch of assets which are available as collateral in the background. So God forbid if they go into liquidation in the future, those assets are going to be liquidated, and whatever money is collected by selling off those assets will be distributed to people like you who've invested money in these debt securities. However, insolvency proceedings are not that simple. So the harsh reality, if you've read news of ILFS, DHFL, Franklin Templeton, bunch of others, when a company or an issuer of debt securities fails in some way and goes into court proceedings, the proceedings are really long. So it's not that, if they fail, you're going to get your money. Your money is blocked for an extended duration of time till the time the entire process of insolvency is not carried out, which means a liquidator is appointed who's going to examine all the assets, value them, sell them off in the market, collect the money. And now that money is paid off to various people and stakeholders in a particular order of preference as defined under the law. So the government is going to get its share of taxes first, then of course come trade creditors, then there come secured other secured lenders such as banks and stuff who've got actual assets, defined assets against which they've given money. And there's a possibility that by the time it's your time to get the money, all that money which was collected after liquidating the assets is already over and you haven't gotten anything in return, despite the security that you invested in was a secured asset and this was a secured debt. Now, how do you counter this situation and find some fixed return debt security or a bond which is actually secured by assets solely for you, which means that if that issuer goes into liquidation tomorrow, you will not have to wait for all this preferential payment of whatever money is collected on liquidation and have to wait for your return whether anything will be left for you or not. Here comes the investment option of covered bonds. Now, what really are covered bonds? These are issued by banks and NBFCs in a manner where, say, a bank lends its money to people, borrowers, for several purposes: vehicle loans, gold-backed loans, housing loans. Now, all these borrowers of banks have actually put their assets with the bank as collateral. So the bank essentially in the end, or the NBFC, has a lot of gold reserves, has house properties, has vehicles. These all assets are available with the bank. Now say the bank or the NBFC wants money. What are they going to do? They are going to create a pool of these assets which are available with them and say that securing these assets or against these pool of assets, I want to now borrow money from people outside in the market, say people like you and me. So how do covered bonds work? Imagine an NBFC has a bunch of these assets but doesn't really have money anymore because it's really lent out a great chunk of its money in the market. It's going to create a trust. Now the purpose of the trust is going to hold all of these assets as a collateral against a bond that this NBFC will now issue in the market. So say for example, this NBFC is issuing or wants to raise 100 crores from the market. It has to ensure that it keeps a pool of assets worth at least 125, 150 or 200 crores in this trust, so that even after the value of these pool of assets depreciates, it is enough to be able to repay these people in the market who've put in their money in a covered bond. This is called a covered bond. issued primarily by NBFCs currently in India. It's a global concept, but is fairly new to India. Earlier, a lot of HNIs would put money in covered bonds because any NBFC or bank would want that, okay, I'm going to approach a person who can give me 100 crores of money against all these assets that I have, which can tomorrow be used to, liquidate and pay off the money in case I cannot through my own business. However, recently has come a phenomenon where a lot of retail investors can also invest in small ticket sizes in covered bonds. One option available for you to invest in them is through this website called wintwealth.com. So you can go to wintwealth.com, you can look at all the covered bond options available with them. So the bond options, they promise a return between 9 to 11%. Some are backed by gold, a few others are backed by house properties, some are backed by vehicles. You can choose whatever bond option is right now available for you to take. You can go through all details of what is the asset pool size, what is the total issue size of that covered bond, what kind of return are you getting, and you can put in money in those covered bonds. So there are unsecured bonds, there are secured bonds, and then maximum security, there is covered bonds. Explore these options, read more about it. Please invest only after understanding what these investment instruments mean. And most importantly, share it with someone who may need it.